In this chapter, we will learn what is GDP and why it's important to understand. The full form of GDP is Gross Domestic Product. GDP is the total market value of all the finished goods and services produced within a country in a specific time period. This means in our case, the total market value of all products and services produced in India represents the GDP of India. If a product is manufactured in a foreign country and sold in India, it won't be considered as a part of GDP. Normally GDP is calculated on annual basis. So if we multiply the total number of products and services produced in India in a particular year with the average price of the products, we will get GDP. Though calculation of GDP is a very complicated process, where we consider many variable factors like consumer expenditure, industry's expenses, government expenditure, import, export, etc. But for ease of understanding, we will keep things simple at first. Let's assume, in a particular country, in a particular year, total 1,000 products have been manufactured. The average price of those products are 200 rupees. The GDP of that country is 1,000 multiplied by 200 equals 2 lakh rupees. A country will produce more products only when they have a very large domestic market. They export lots of products to different other countries. Indirectly we can say, countries with big GDP numbers have big domestic markets where people can afford to spend a lot of money to purchase products. Or, the country exports a lot of products to other countries, which means they also earn a lot of money from exporting. So in other words, GDP tells us the economic health of the country. Bigger the number, better the economy is. Which are the factors that affect GDP? First of all is the population. Bigger the population is, bigger the size of the domestic market. A large domestic market is always a big advantage. India's ever-growing population is a big advantage. Secondly, the purchasing power of people in the country. What's the point of having a huge population if most of the people are below the poverty line and can't purchase? Even if we have lots of consumers, without purchase power, it will be useless. So GDP growth is also an indication of improving purchase power. Thirdly, business environment. Let's assume a country has a big market, but it doesn't have a business-friendly environment. In India, strict land acquisition law, strict labor laws, and other difficult policies create unnecessary barriers for business. Without a business-friendly environment, industrialists struggle to create profitable businesses. It will also discourage investors to invest. Without investors, companies can't grow. If companies can't grow or struggle, they won't be able to hire people. If they can't hire, people won't have a job. Without jobs, people won't be having money. Which means, we will have a large pool of consumers, without purchase power. It's a never-ending cycle. So improving GDP number is an indication of a better business environment. Fourthly, government investment plays a huge figure. If the government invests more money to build infrastructure and other things, not only it will improve the quality of life in the country, it will create jobs. The companies directly or indirectly involved in those projects will make lots of profit. They will further hire people to grow. Even more people will get a job. This cycle will slowly improve consumption. Pause the video and watch the flow chart carefully. So more and more products will be produced, and GDP will improve. There are so many other factors like interest rate, tax rate, laws and regulation, international affairs, etc. affect GDP. That's why GDP gives us an overall picture of the economy. Better the number, better the economy, better the economy, better for businesses. If GDP is growing very fast, we can say businesses are also growing fast. As an investor, we love to invest in companies which are growing fast, as eventually, that will make more profits for us. As we have already observed, over time, the price of every product or service increases. This gradual increment of the price is called inflation. As we know already, the two most important factors, which affect GDP are number of products or services produced, and price of the products or services. So if price increases, GDP will increase. That's why inflation is a very important part of GDP. Now GDP can be both inflation-adjusted or unadjusted. If inflation is considered, then it's called real GDP. On the other hand, nominal GDP is unadjusted for inflation. In case of India, at the time of making this video, the nominal GDP growth rate is 5.8% and inflation is 6.4%, so the real GDP growth is 5.8% plus 6.4% equals 12.2%. The top 50 companies in India, as per market capitalization, represent 67% of Indians' GDP. This means, we can say, Indians' GDP largely is dependent on the top 50 companies, though they are all different. For ease of understanding, let us put it this way: if we invest in the top 50 companies, as per market capitalization, we are investing in the Indian economy. So if GDP is growing at 12.2%, our top 50 companies will grow at least at 12.2%. So even if we blindly invest in the top 50 companies, we should at least get 12.2% return. Also, we didn't consider the dividend company pays to investors. Dividend is the part of the profit company pays to its shareholders. Dividend increases the return by an additional 1 to 2%. These days, even when the economy is slowing down, still we can expect a return of 13 to 15% by simply investing in top 50 companies. As the time of making this video, banks are paying only 6.7% for fixed deposits. That's why investing in business is always rewarding. We can blindly make anywhere from 13 to 15% return by just simply staying invested for the long term. And if we know how to invest, we can boost the return by an additional 10% easily. We will learn how to turn this 15% average return into an outstanding 25% return. But before that, we need to understand what is economy and inflation. In the next video, we will discuss in detail what is an economy. If you liked our video, please like and subscribe. Also, we have a course on technical analysis, where you can learn directly from professional traders. With their guidance, you can become a professional trader in no time. Thanks for watching our video.